Good morning and welcome back to Almus Market Mornings, your daily dose of global financial updates. Attention would be on the US CPI figures today evening. The previous print for the year-on-year headline number was around 3.2%. Markets would be keenly looking at the current print, as in the current set of narratives we have been observing rate cut prospects slowly dwindle. Morning, JK. In the past two sessions, it seems we have seen yields cool off, some recovery in euro, stocks have done okay. What's your expectation from the CPI? Can it be a market mover?
Uh, Good morning, Swaraj. Yeah, there's a lot of factors that is being considered by the markets, both equities, stocks, and also the currency market. Uh, the yields have dropped a bit because the multi-day sell-off in the bonds saw some profit taking from the shorters, and that led to some retracement in the yields. And also there was some relief, for due to second successive day of fall in oil prices, as Middle East ceasefire talks have continued in Cairo as well. Yes, as I said, there's a lot of uncertainty about Fed's monetary policy. While the dot plot showed median expectations for three rate cuts, it appears that in public, many members have actually been vocal about not hurrying to cut rates. And in fact, one member, Mr. Bowman, raised the possibility that central bank's next move could be to raise rates if inflation turns out to be stubborn. Then March survey of consumer inflation expectations saw a year from now unchanged at 3%, that's inflation, whereas for 3 years from now, they increased it from 2.7% to 2.9%. We also had a surprising, statement from James Bullard, who is a known hawk and is not a Fed member anymore. He said that three interest rate cuts expectation this year is quite, on par. Because central bank has got a handle on the inflation and the economy also remains resilient. So he favors three rate cuts. Now, you take whatever argument that you want, but markets are really not conclusive one way or the other. The CPI number expectation today sees some relief from previous month. Month on month, 0.3 versus 0.4 previous month. Then the core inflation rate year on year, 3.7 versus 3.8. So all across there is some relief, but then the headline inflation rate, not the core, is expected at 3.4 versus 3.2%. So a kind of mixed expectation from the CPI data. So this is what the bond market has been keenly looking at, because there was already a big jump from the recent lows in the yields, and if inflation turns out to be worse, then further increase in the yields cannot be ruled out. That, and also the expectation, or rather suspense about the corporate earnings in the face of high interest rates for the Q4 is also keeping the stock markets quiet. We had 12% rally in the first quarter of this year in S&P 500, preceded by a 26% rally in 2023. So it's in a zone where valuation concerns are increasing, and uncertainty about Fed policy move is also there. So really, we need for stocks to gain from here, we need to see very good corporate numbers as well. In the last 2 days, there wasn't much of a data. Only the data that we saw was the small business optimism that reached the lowest level since 2012, and that is some concern, definitely. What is observed is that the big companies are, somewhat protected against these economic uncertainties, but the small businesses have been affected. This is the 27th consecutive month that we have, below the 50-year average of 98. And the net percentage of owners raising average selling prices rose 7 points from February to a net 28%. So basically, the small businesses are facing a lot of issues, mainly due to inflation and also the high interest rates. Then coming to the dollar, behavior dollar has been somewhat strange. All rally on good news from US economy, and there have been plenty of them. That has been limited, while we have swift declines on any soft data from US or hint of good news from other economies. The undertone of the dollars looks a bit weak, Not so much explainable, but it definitely reminds me of gold's recent rally that happened without any major trigger. So, is any such thing building up for the dollar? That is something we have to look out for, because gold's rally, apart from being safe haven and diversification, may also indicate certain dollar weakness, which can seep into the other currencies as well. We also have the sword of intervention hanging over Japanese yen market, with more voices being heard from officials yesterday. BOJ said they might raise inflation view due to strong payroll deals. Let's remember that in 2022, uh, when yen was at similar level and BOJ intervened with a massive amount of more than $30 billion, overall dollar index itself fell by more than 10%. So if there should be a large scale intervention now, we might see a larger dollar move also, because the dollar is proving to be a bit weak overall. So it's a wait and observe. CPI is just one trigger, and of course we also have PPI numbers this week. All this needs to be adjusted, and of course we have the ECB meeting this week, rather tomorrow itself, where ECB is more likely to cut rates in June, because their data has been still not so strong, and the disinflation is definitely continuing. So these can be a dampener for euro rally, but then so far Europe market has not reflected that, and euro has been standing firm in the face of strong US data as well. Incidentally, we have two policy meetings. One today, New Zealand maintained rate at 5.5% unchanged, and Canada also has a policy meeting today at 8:30 p.m. India time, and they are also expected to keep rates up. I think everything is now hinging on where the Fed moves from these levels. Coming to rupee, the uh, retracement in the dollar, and oil unable to build on its gains above 91, Brent oil that is, and some amount of buying pressure abating due to the postponement of the rule for ETCD derivatives. So all that helped rupee gain a bit towards 83.22 on Monday. But 83.20 being a very strong support zone where importers have an interest to buy. And in view of the strong data, in view of the important data that's coming up today, tomorrow, and also the Indian inflation number that's due on Friday, market might be cautious about selling too far into this, short-term strength in the INR. So I feel 83.20 likely to hold broadly. In a slightly wider range, 83 and 83.50 should be holding on for the timing, unless we see a big change in the monetary policy perspective globally. So that's the thing. Indian markets otherwise have been holding up. Indian yields have also gone up in line with the global yields, 10-year yield touching 7.15. So that's something we need to look forward to, because I think the flows have also come down. That's not helping the bond market right now. But medium term, yes, I think we will be seeing more flows and the yields to come down. RBI, rather the CPI data from India expected to show lower on Friday. So we wait for these crucial data before we take the next move on the currencies.
Thank you, JK. And just quickly summarizing, one interesting narrative that is developing is, of course, when we talk about the Fed, the three rate cut showed in the dot plot has been contradicted by the Fed members who have been vocal about the risks of cutting rates too fast. In fact, even raising rates if inflation doesn't cool off is something some Fed members have mentioned. And if today's CPI print turns out to be worse, we can see some jump back in the yields. The corporate earnings season is slowly going to arrive, and in the face of higher rates, markets will be looking at the earnings for the Q4 and how they fare. For rupee, Retracement in the dollar and fall in oil prices has resulted in some gains. 83.20 remains a very good support, and we'll keep tracking that. That's it from us today. Thanks for listening. Tomorrow is again a market holiday on account of Bakrid, so we'll catch up with you on Friday with the latest in the financial market.